Welcome everyone to another financial analysis video where we analyze companies for you and raise your financial awareness. My name is Moeed Amin and I'm joined with Ted Wayman. So today we're going to be looking at a well-known company, Alphabet. Now what we're going to cover around Alphabet are a few critical points in terms of the financial statement and how you can analyze their financial results, whether you're thinking about investing in a company like Alphabet, selling your services to them, or if you're thinking about joining them as an employee and you want to sound smart in the interview. So before we go on to the analysis and some interesting areas that we looked at around the finances, a few things that are important for you to understand in terms of context. So firstly, what does Alphabet do? Well, you will know them as a Google company. They obviously created a parent business. And the reason why is, as Larry Page puts it on the website, there are a collection of businesses, of which the largest is, of course, Google. But there are a few other companies like X Labs, which is almost like the incubator. And they also have the ventures and capital business, where they invest in interesting startups and technologies, etc. A few other things to note. When you look at their last quarterly statement, it's always important to look at that. We're not going to look at that today. We're going to be looking at the annual report, the audited set of financials. But just to understand around the forward outlook, one of the areas that they're going to actually invest a lot in is the Google Cloud service. Actually, you're going to see that as their biggest increase in terms of headcount for technical people and salespeople. So interesting point to note in any future analysis that you do. The other thing to look at is obviously compared with 2021, their 2022 set of accounts you're not going to see as much of a growth as you probably saw there. In the words they use, lapping the COVID-related weakness in 2020, essentially basically saying, there's a lot of growth in 2021 because 2020 was not as big as a growth. And obviously we can't expect that 2022 will be the same level of growth compared to then. So worth noting about that. Couple of important notes before I talk about the share price, and then we'll come on to that later on with the analysis. Number one is that the board recently voted and agreed on a $70 billion repurchase of stock for Class A and Class B shares. Obviously, that's going to obviously, that's going to have an impact on share price, and that tends to raise or inflate the share price, so worth noting about that. The other thing is that they've also announced that they're going to create a 20-to-1 stock split, which will happen on July 15th. Again, typically what happens is, the share price will tend to go up and then come back down again to its previous levels, usually in anticipation and excitement of the stock split, because that means it's more accessible to the average investor or retail investor. Again, something to note, but important information as context. Share price movement. Now, they floated in 2004. If you'd invested back then and held on to your investment, you'd be sitting on a profit of 3,856%. Pretty good. If you invested 5 years ago, you'd be sitting on a profit of only around 117%. And if you invested a year ago, as with most technology companies, you'd be sitting on a loss of 12%, although quite frankly, that's not as bad as other companies out there. So they've clearly weathered the storm quite well so far. So important to note, good context. We'll talk about that a bit more later on in terms of the finances as well. So Ted, let's share with our viewers what we've uncovered about the finances of the company and help them analyze not only this current financial statement, but the future ones as well.
Absolutely. So good to see you, Moeed. Thank you very much. And welcome to all our viewers. Don't forget to like, share and subscribe to the channel. And if you subscribe and you are giving us recommendations, then we will, you'll get a notification of that recommendation. If you're a subscriber, you get a notification of our videos when they come out. So here is the Alphabet Annual Report 2021. There are some quarterly earnings out there, but we're going to look at the annual report. Lots of information in the annual report, all those different companies that Moeed was talking about. If you want to know more about who they are, what they do, and why you should be investing, then this is the place to go. However, we are going to whiz all the way down through to the financial statements. That's where we are focusing our efforts as we try to help you to read and interpret financial information. So here we go. Here we see the financial information for Google, or rather for Alphabet, obviously. And we're looking at this right-hand column, so don't get confused. So sometimes we get a little bit missed out on that. So we're looking at this right-hand column here. This right-hand column is where we see the 2021 numbers. We are in dollars and we are in millions. So the revenue for Alphabet is about $250 billion, $257 billion. And as Moeed said, a significant increase on 2020, which is also an increase on 2021. So this is about a 41% increase. And as Google or Alphabet are saying, that, you know, we did increase by 41%, but don't expect that to continue 40% every year forever. We got the cost of generating those revenues. So that's the kind of their cost of actually, they don't talk about cost of sales because they're not selling anything. So it's the cost of all the kind of the data and the algorithms and all that kind of stuff. It's 111 billion. Now I don't know the business well enough, but that's their costs. It seems quite a lot to be running a search engine, but hey, there you are. 43%, leaving them with a gross profit margin of about 57%, still pretty profitable. Lots of research and development. They really want you to know about this number here. So they are investing in the future, very, very conscious that this is a fast moving world and they can't rest on their laurels. Very strong marketing and sales, so the kind of advertising, and then we've got the kind of the back end, general administrative costs, all the kind of rent, rate, light, heat, finance, IT, HR, etc., etc., etc. Bringing them down, there's the total cost, 179 billion, leaving them with a profit of nearly $79 billion. A little bit of other income, I say a little bit, it's 12 billion, it's not exactly a little bit, but there's and it's interesting, it does say net, and this means that they're getting some other income and some other expense, and it looks to me like they're kind of netting it off. So if they do have debt, that's where the interest is, but we can't see that interest. So we'll look at the balance sheet a little bit later on to see if they've got any debt. But if they do have debt, then the affordability is not a problem. That's the net income rather than a net cost. And then we've got the tax that they're paying as well, about $15 billion. Keep the US Treasury very happy. Net income, bottom line, $76 billion, 30% margin. 30%. That's a really, really large percentage, up from 22% in 2020. So for every dollar they bill, the shareholders get to keep, or the company gets to keep 30 cents. And obviously that 30 cents can either be returned to the shareholders or it can be reinvested back into the business. So there we have the income statement, our summary, our conclusion. Very, very, very profitable company and growing rapidly, continuing to grow rapidly. Big company, still growing. Here's the balance sheet. Balance sheet shows our assets and our liabilities. If you remember, we've got the non-current assets, the thing we need to kind of run the business, are all of these numbers here. And then the current assets is the things which are either cash or going to become cash are here. Now let's try and analyze some of this. So in the non-current assets, sorry, in the current assets, we've got about 140 billion of cash. Now, those of you who've been watching these videos for a while will know actually, this is interesting. It says non-marketable securities rather than marketable securities. So these are, non-tradable kind of investments. So they've got a lot of cash, 140 billion, 40 billion of accounts receivable, not a lot of inventory, but then that does make, that kind of makes sense. They don't have a lot in the warehouse, 188 billion in current assets, quite a lot of property, plant and equipment. If they're moving into these web services, they're going to need lots of server farms. They probably don't rent their offices, they just buy them, because they can afford it, because they just got tons of cash. And they've got some assets which they have under operating leases, and these are investments. These non-marketable securities will be investments in unlisted companies. So this will be their kind of Moeed was talking about their kind of incubator investments. And quite a lot of goodwill on there as well, showing that they are an acquisitive company. They are buying other companies. That's one of the ways that they grow. So there's kind of an investment arm almost to it. On the bottom side, on the liabilities, here are the current liabilities. Current liabilities way smaller. I mean, you know, half the size of the current assets. So really, liquidity is not an issue for these guys. You know, very cash generative business. And they've got things like deferred revenue, which is income that they've received but they haven't yet earned. And then accrued expenses and accounts payable and a bit of compensation going on there as well. So, you know, really not a lot. You can see the debt. There is a little bit of debt. I say, you know, a little bit. I mean, it's 15 billion, which for you and me is probably quite a lot. But for these guys, it's really insignificant. So they'll be paying interest on it, but it's not something that keeps them awake at night by any means. So they really don't have a lot of debt, and therefore their equity, look at the equity on the balance sheet, $252 billion. That's $250 billion, which is effectively investment, 62 billion, and about 200 billion of retained earnings. So they are making a profit. If you remember, they made a profit of 76 billion and their retained earnings have gone up by about 30 billion. Now, that tells us that they must have been distributing some of that profit. So what we can do is we can go and look at exactly what they were doing with that profit and how they were distributing it. And that is in the movement in equity. So if we just whiz down here, here's our movement in equity. Now, as Moeed said, they were talking about this kind of big share buyback. That's what they have been doing. 2018, 17 billion of share buybacks. 2019, they did about 30, just shy of 30 billion of share buybacks. And in 2020, they also did, 2021, they also did about 50 billion of share buybacks. So these guys, they're just doing a lot of share buybacks, no dividends. Okay, so no dividends, you're not getting any income, but the value of those shares is going up. There are a big purchaser in the marketplace, and therefore that's going to be pushing the share price up. Now, one of the effects of that is to impact the earnings per share. So let me show you what I mean here. We're back in the income statement. So here we can see the earnings per share from 59 to 113 cents per share. So 59 cents per share to $59 per share to $113 per share. So the increase in the earnings per share is partly driven by the increase in the profitability, but it's also driven by a reduction in the number of shares. And what they're going to try and do is to carry on with that so that you are earning an increasingly large amount per share effectively. Okay. Right, last thing to look at is our cash flow statement. Here is the cash flow. So as you kind of expect, these guys, I mean, they are just generating tons and tons of cash. $92 billion in cash. They are investing a lot of that. So up here, we've got kind of purchases of marketable securities. This is kind of cash movements. Those of you who've seen these workshops before, these videos before, will know that that's kind of where companies who just generate a lot of cash just park cash. There's a little bit of distortion going on there, but they are buying property, plant and equipment. They are investing in the business, and there's usually a little bit of kind of, you know, buying non-marketable securities, which is kind of investments and acquisitions of other companies. So about 36 billion they're spending on their on investing. So lots and lots of cash, way more cash than they're investing, and so they're using a lot of that spare cash in order to repay the shareholders. So they're using it to kind of, you know, pay out awards to repay. And you'll notice here there's a little bit of debt refinancing going on. So those two numbers together basically map each other out, and therefore they're not taking on more debt, but they're not trying to pay down their debt. So really, the kind of sum total is that these guys, they're making 90 billion in cash, spending 35 billion investing in the company, and the other sort of 50 to 60 billion, they are, you know, what, 10 billion they're giving to their shareholders, to the employees as stock options, and also they're giving to their shareholder, to their staff, as a reward for stock options they've purchased in the past, and then 50 billion they are using to repay, to buy back their own shares. And again, that's going to have a very significant effect on that earnings per share. So these guys have got some really, really strong numbers coming through, very strong balance sheet, EBITDA, profit margin 35%, if that means anything, very little debt, liquidity not a problem, no problem in terms of the debt. Working capital just isn't an issue. Some really strong shareholder ratios, 30% return on equity, for example. And the dividend and buyback cover, or because it's only buyback, is still pretty strong too. 76 billion of profits, 48 billion of share buybacks, not a problem, and cash flow very, very strong. So if we look at the kind of the shareholder element, and we just go back and look at the share price, obviously benefit of hindsight, and what we should really be doing is filling our boots, just selling our houses and selling everything else and filling our boots back when they floated, and then just riding the wave all the way up, and then popping out of the top of the market. These guys are off the top. Okay, now everybody's off the top, and this is very much inflationary. And they're caught up. They're a tech company. They're caught up in the exuberance on the way up. They're caught up in the kind of the dash for cash on the way down. However, there are a lot of companies out there who have very poor business models, who aren't generating cash. They're jammed tomorrow, and they're the sort of companies who are going to carry on all the way down here. These guys, I don't think are. Okay, so there is a correction. The question is that a buying opportunity? Well, look at the numbers. They're valued at 147, nearly $1.5 trillion. PE ratio, 20 times earnings. 20 times earnings, that's about a 5% yield. 5% yield in 10% inflation means you're losing money. However, these guys are going to continue to generate money. They're going to continue to generate cash. I can't see their profitability falling off. They are going to carry on growing, maybe not as rapidly as Moeed said, but 5% yield does not appear unreasonable. So they're not screaming cheap, but they're not screaming expensive either. They're not trading on 100 times earnings or 1,000 times earnings like certain electric car companies that we have analyzed in the past have. Obviously, the PE, the dividend yield is nil because they're not paying out a dividend. But if you look at the share buyback yield, then it's a 3.3%. And remember, share buybacks is just another way of trying to return that value to the shareholders. And quite interesting, if you look at the PEG ratio, for those of you who are into your real kind of meaty analysis, the PEG ratio, because the earnings per share has gone from $60 to $113 per share, that's a 93% rise in the earnings per share, and therefore the PEG ratio is about 0.21. Now, anything below 1 is a kind of screaming buy, but don't forget, it's not just because the profit has gone up, it's because the number of shares has gone down. Now, final thing, Moeed talking about this share split. Look in the top left-hand corner, and you will see the value of a share. Now, that is quite a lot. And so, in effect, what they're going to do is to say, rather than having to pay $2,234 per share, what you're going to do is that if you own one share, which is worth $2,234, they're going to take that share away from you, and they're going to give you 20 shares which are worth 1/20th. So in effect, it's about, what's that, $100 per share, for example. So rather than having one share worth $2,000, you get 100 shares worth $20 each, for example, and the math is basically the same. Or rather, 20 shares worth $100 each. So the math will come out of the same. So don't worry too much as a shareholder about that, but as an investor, it increases liquidity, because there's lots of people who go, oh, you know what, I haven't got $2,500 to buy one share in Google, but I do have $400 to buy a couple of shares in Google, for example. So it increases the liquidity. So that's good For shareholders, it means that you can sell part of your shareholding. It's good for investors. It should be good for the share price. So that's where Moeed was sort of talking about, it tends to have a sort of a positive effect on the share price because it increases liquidity and it allows people to trade who hadn't otherwise been able to trade. So that's got to be a good thing. So it's not going to affect these numbers. It's not going to make the company necessarily much more profitable, much less profitable, but just to be aware that that is often a kind of an impact. However, we are in rocky times. We are in inflationary times. Tech stocks are taking a hammering. That's not to say that this can't carry on going down. But I would suggest that if you're looking to invest in this company and you buy into the, I'll just go back here. So you're going to buy into the growth. This is kind of pretty steady growth. If you reckon it's got ahead of itself and you think, oh, you know what, it's kind of back to where it, if that's your kind of Chartist line, then maybe, anywhere down here, this is a buying opportunity. And that's very much a Chartist approach rather than a sort of a fundamental value investing approach. But these guys, they're not cheap. They're not overly expensive. They're not in my portfolio. I'm kind of thinking, there's no reason why they shouldn't be in my portfolio. Maybe given the current turmoil, I'll sit on the sidelines a little bit longer and see if I can pick up a real bargain rather than just something which is kind of reasonably priced, Moeed. How about that for an analysis for you?
Yeah, sounds pretty good. And couple of points to note, obviously staggering numbers that you just saw there. And in fact, they're one of 6 companies in the world that's got a market cap of $1 trillion and above. So not surprising. However, as Ted just talked about, if you want to sit on the sidelines or not, bear in mind in a recession environment, what tends to happen, no guarantee of the future, but what tends to happen is one of the things that companies reduce their spend on is advertising. And as we know, Google is basically an online advertising business. So something to think about in your thesis if you're thinking about investing in a company like Alphabet. So thank you, Ted. If you have any comments, do leave them in the comment section. Now, this particular video was not a request from our viewers. However, about 98% of the videos that we publish are requests from reviewers. So if you have a company that you're really interested in seeing our analysis on their finances, do leave a note in the comment section. Leave some notes or some context behind that, because the more interesting the context, naturally, the higher likelihood that your request is going to be prioritized. And of course, don't forget to like, share, and subscribe, particularly subscribe, because you will get a notification when we publish your request. So till the next video, thank you, Ted. Thank you, everyone. We'll see you on the next one.
Good to speak to you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share, and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions. And do recommend any videos, any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up. So please do take the opportunity, have a look at the other videos, and don't forget to like, share, and subscribe to the channel. And I will see you on the next video.